Hi guys, so this is the next video in the chapter 15 series. So today we'll be looking into analyze the financial position of a business using financial ratios. Now let's start off by looking into what ratio analysis means. Ratio analysis. Ratio analysis refers to the analysis of various pieces of financial information by ratios in the financial statements of a business such as its profitability, liquidity, and solvency, etc. Financial ratios are important to understand the functioning and the financial condition of a business. Financial ratios can be classified as follows: liquidity ratios, profitability ratios, activity ratios, leverage ratios, or gearing ratios. Liquidity ratio. Liquidity ratio shows the ability of a business to meet the short-term liabilities. Similarly, this ratio is used to identify the short-term solvency. Some of the liquidity ratios are current ratio and quick ratio. Current ratio. This ratio shows the relationship between the current assets and the current liabilities. It is generally accepted that the current ratio of 2 is appropriate, but this may differ according to the organization. Quick ratio. This ratio shows the relationship between the current liabilities and the liquid assets. Assets with very low liquidity that are in current assets are removed when calculating this ratio. It is generally accepted that the quick ratio of 1 is appropriate, but this may differ according to the organization. Profitability ratios. Profitability ratios show the amount of profits earned on assets, share investment, and sales. Some of the profitability ratios are gross profit ratio, net profit ratio, return on investment, return on equity. Gross profit ratio. This ratio shows the amount of gross profit on sales as a percentage. The pricing policy of the business is shown through this. Net profit ratio. The net profit of the business is shown as a percentage of sales through this ratio. Here the profit before tax is considered as the net profit. Net profit ratio is used to measure the efficiency of operational activities. Return on investment ratio. This ratio shows the relationship between the returns of the business related to the total investment as a percentage. Return on equity ratio. The return earned for the capital invested by ordinary shareholders is declared as a percentage through this ratio. Operational ratios or activity ratios. The relationship between investment in assets and earnings created by them is shown by the operational or activity ratios. Some of the operational ratios are inventory turnover ratios, debtors turnover ratio, total assets turnover ratio. Inventory turnover ratio. This ratio shows the speed of converting the inventory into sales quantitatively. Debtors turnover ratio. This ratio shows how efficiently the business collects the cash from its debtors. Total assets turnover ratio. This ratio shows the relationship between the total assets of the business and its sales. In other words, it shows how efficiently the total assets of the business have been utilized. Leverage ratio. The ratio that shows the relationship between the equity capital and the loan capital of the firm is known as leverage ratio. Some of the leverage ratios are debt ratio, debt to equity ratio, interest coverage ratio. The debt ratio. This ratio shows as a percentage how much of the total capital of the firm consists as debt capital. Debt to equity ratio. This ratio shows the relationship between the equity owner's capital and the capital for which a fixed interest is paid. There is the loan capital. Interest coverage ratio. The number of times that the interest can be paid using the earnings of the business is shown by this ratio. Now let's look into the benefits and limitations of using ratio analysis. Benefits of ratio analysis. Performance evaluation. Ratio analysis helps to assess a company's financial performance over time. By comparing ratios from different periods, it enables analysts to identify trends. strengths and weaknesses in a company's operations, profitability, liquidity, and also efficiency. Benchmarking ratios provide a basis for comparing a company's financial performance against industry standards, competitors, or even its own historical data. This benchmarking allows businesses to gauge their relative position and identify areas for improvement. Decision making ratios assist in making informed decisions. For example, analyzing profitability ratios helps assess the profitability of different products, divisions, or business segments. Similarly, liquidity ratios aid in evaluating a company's ability to meet short term obligations. Financial health assessment. Ratio analysis helps to determine the overall financial health and stability of a company. By examining solvency and leverage ratios, analysts can gauge a company's ability to handle long term debt, financial risks, and potential bankruptcy. Forecasting and planning. Ratios can assist in financial forecasting and planning. Historical trends in ratios can serve as indicators for future performance, aiding in budgeting, setting financial targets, and formulating strategies. Now let's look into the limitations of ratio analysis. Limited to quantitative data. Ratio analysis relies solely on quantitative financial data and does not take into account qualitative factors. It does not consider market conditions, industry dynamics, management capabilities, or external factors that can significantly impact a company's performance. Lack of standardization. While industry benchmarks exist, there is often no universally accepted standard for ratios. Different industries and companies may have unique characteristics, making it challenging to establish a definitive benchmark for comparison. Historical perspective. Ratio analysis primarily relies on historical financial data, which may not reflect a company's current or future conditions accurately. Rapid changes in the business environment can render historical ratios less relevant. Manipulation and interpretation challenges. Financial ratios can be manipulated by creative accounting practices or the selection of accounting policies. Additionally, interpreting ratios requires expertise and context, as an isolated ratio may not provide a complete picture of a company's financial health. Industry differences. Different industries have varying business models, revenue recognition methods, and capital structures, which can make comparisons across industries meaningless. Ratios that are appropriate for one industry may not be applicable to another. So that's it with this video, guys. Please do like and share to learn and let others learn. Thank you.
Created using Powtoon.